Hey, Mike Kestner with the PCIP Leadership Podcast today, live from Austin, Texas. Our guest is Duane Jackson. Duane, where does this podcast find you today?
Good morning, Mike. It's a real pleasure to come to you and speak to you today. I am working from home, as I have been for the past almost a year now. Strange environment we live in. I'm based in Chicago, Illinois.
Gotcha. And Duane, I know you picked a great time. I want to ask you some stuff about your, personal life. But before we get there, you picked a heck of a time to start a fund. Give us a little background on yourself and the pros and cons of starting leaving BDT and starting a new fund several months ago.
Absolutely. I'm more than happy to share, my background and the story. But again, it's a real pleasure to have the opportunity to share a bit about what I'm building here at Jackson Private Capital. I am a Chicago native, and so a bit biased on the city. I think it's a very, very a strong city, a great city. But when I decided to set up shop with my own firm, it was only natural to set up that firm in Chicago. I've spent the better part of my career as an advisor and investor to business-owning families. Initially starting off my career as an investment banker at Merrill Lynch, covering financial institutions. That included banks, insurance companies, financial technology companies, asset managers, specialty finance companies. And this was from about 2005 up to about 2009. And so as you can imagine, there was a lot of deal flow. It was a typical investment banking analyst hours, 100 hours a week, up until the financial crisis, when everything came to a halt. And at the onset of the financial crisis, I was starting to really get my bearings around where I wanted to take my career. Had a very keen interest in focusing on a career in investing. Wasn't quite sure if that was private equity or hedge fund. After I met a few hedge fund investors, I think I quickly realized I am more inclined to do something that's more long-term oriented, something where I could actually lock arms with owners and entrepreneurs and really guide them toward building value in their enterprises. And so that really led me to cast the net across Chicago, a lot of the larger private equity firms and organizations here, to try and find, an opportunity, a pre-MBA associate role. Given it was a financial crisis, nearly every firm that I spoke to, that I reached out to, said, you know what, we don't know what the world's going to look like, next year when you're looking to start, yet alone tomorrow. So let's stay in touch, come back to us. Meanwhile, a colleague who I had worked very closely with early in my career. I started off in the New York office of Merrill Lynch and then moved to Chicago. That colleague in New York had left Merrill Lynch. He had joined the U.S. Treasury Department, and he gave me a phone call. He said, Duane, we're putting together a small team down here. We're trying to build it out pretty fast, and we work together. I know your work style, your work ethic. I'd love to have you on it. And initially I said, seems interesting. And I went down and I met the team. There were about 15 people in the Chief Investment Office for the Troubled Asset Relief Program, TARP, affectionately known as the Bank Bailout Program.
Right.
And I think I saw it as an opportunity to really be able to learn from a lot of very senior people on Wall Street, private equity executives, senior investment bankers, many of whom had put their careers on hold to do something positive and necessary. Not only did I see it as an opportunity, but I felt like I had a real responsibility to do it as well, given the skill set that I had developed over the past 4 years as an investment banker to banks. And so I spent a year and a half in DC doing that, working on a number of different programs and initiatives under the Troubled Asset Relief Program. Frankly, I think I'm the most proud of the things that didn't necessarily hit the headlines, the things that the team and I were able to actually diffuse, and just the work that we did overall to help get the financial system back on track. After a year and a half of that, I found myself back home in Chicago working with a family office. And it was my first encounter, frankly, with a family office and understanding, and had the opportunity to understand how, frankly, business-owning families engage with the world of business and how prominent they are and the roles they have. And I'd say especially how powerful the long-term ownership mindset is. I worked with that family in Chicago for about 6 months and then found myself out in Boston at Harvard Business School. while at Harvard Business School, was fortunate to connect with the Fireman family. Paul Fireman, a long time ago, bought Reebok. He built it up into a brand that we know it to be today, and he ended up selling that business to Adidas. He took his proceeds, and he and his son took those proceeds and essentially set up a private equity fund, one that was consumer focused, but broader than athletic apparel, which you would obviously imagine, as their core bread and butter and expertise, but focused on consumer at large. While I was with them, I had the fortune on working on a really fun acquisition of 2 craft beer operators. And I think interestingly, that's an investment. They completed it in 2012. So here we are 8 years later, and they still own it. They've continued to acquire other breweries. They've continued to build that business just as a family business owning family does. And they've developed, I think, a pretty impressive track record of doing acquisitions successfully with that business and others.
Wow. And you met them at Harvard?
I did. I was actually, it was funny. I met one of their managing directors who came to the Harvard Business School Venture Capital and Private Equity seminar, annual seminar. And we crossed paths there. He said, you've got an interesting background. If you're ever interested in a summer opportunity, come and work with us. And so I was fortunate. And I'll throw a little twist into the mix, which is that I was clawing and scratching for a private equity opportunity. And it came down to the wire. It came down to, I think it was May, right before the summer started, for a summer internship. And I had turned down a number of different consulting opportunities. I had turned down a number of different other corporate opportunities, hadn't landed anything for that summer in private equity. And I think my wife and I agreed that if we were going to move back to Chicago, where we wanted to be long-term, if we were going to do that for the summer, it had to be for a real, tangible opportunity, one that we really liked a lot. So I focused the search primarily on Boston. And, at the 11th hour, frankly, this firm, Fireman Capital Partners, scooped me up. So I was very fortunate to land that opportunity. Remain grateful to Dan Fireman and the family there for creating that opportunity and for all that I was able to learn working alongside them.
That's a great story. And then why don't you continue on? And it seems like, one quick question. It seems to me, I don't know you that well, but it seems to me like you're pretty good at networking, whether that's conscious or subconscious. But it seems like, you can't always be in the right place at the right time. You're obviously following up with people.
That's fair. And interestingly enough, during college, I started off my career at Merrill Lynch in the wealth management division. And I think the thing that I realized working in that role was that it's very much relationship oriented, relationship based. And I saw that as a strength. I knew that coming out of college, I could absolutely excel in that role, understanding the markets, connecting with clients, and helping those clients really understand how their assets are invested and allocated. But I also recognized that it didn't provide enough of a technical foundation for me throughout my career to actually invest. And so I do pride myself on my ability to connect with others and put myself in others' shoes to understand, their considerations, what they're thinking about, what problems exist, and in many cases, to help them problem solve. I think that's what we do best, at the firm that I'm building today.
That's great. I think so many leaders, it seems to a lot of people that's basic, fundamental. But what you said, if you consistently put yourself in people's shoes, it's just so much easier. You get a better feel for what their perspective may or may not be. And certainly as an investor, or it applies in obviously all walks of life. And I think a lot of us are guilty on occasion of not putting ourselves in other people's shoes.
Yeah, I think that's fair. And, at the same time, it has to be authentic. You actually have to care about the person you're sitting across the table from. So you have to care about them and what's in their best interest. And you have to figure out ways to balance what's in their best interest with what's, in yours longer term, and to find agreements that are mutually beneficial. And I think there's always common ground, with anyone that you're connecting with.
Agree. So did you always have in your pit of your stomach a desire to open up Jackson Capital or your own firm, or did this just kind of start matriculating over the last few years?
I've had a long time desire to own and operate a firm independently, really to have my own fingerprints on the culture of an organization and how that firm operates. It frankly really goes back to my days in high school. When I was a high schooler, I was born and raised on the south side of Chicago, somewhat of a tough neighborhood, but found myself very fortunately going to a boarding school on the North Shore of Chicago for high school. And it was while I was in high school that I was sitting in a dorm room, next to two classmates of mine, two good friends, and they were watching the television. They were watching CNBC in high school. I was watching them, staring at them, a bit bewildered, scratching my head. They were talking about EPS and EBITDA, and they were on their computers day trading. This was back when we had computers, laptops that still plugged into the Ethernet, and jack in the wall.
Right.
So fortunately for me, a faculty member tapped me on the shoulder, Dr. S. And Dr. S was an English teacher. And he said, Duane, if you're ever interested in learning more about business and economics and finance, use me as a resource. I didn't really know what that meant, coming from an English teacher. But come to find out, Dr. S had a PhD in economics from Northwestern, happened to teach English as well, but was a very astute personal investor. And he said, this is what we're going to do, Duane. We're going to put together a weekly speaker series. We're going to very lightheartedly, jokingly call it the Junk Bond Society. And we're going to use it as an opportunity to bring in some of your classmates' parents, many of whom lived on the North Shore of Chicago and were corporate, Fortune 50 CEOs, CFOs, private equity executives, hedge fund executives. And we did that on a weekly basis. And I would say there were a handful of conversations in particular, one that remains very strong in my mind because this gentleman remains a close friend and a mentor, Brian Cressy of Cressy and Company, came and spoke. And he talked about his passion for sitting across the table from entrepreneurs and providing more than capital, but providing them, sound strategic advice to help them realize their full potential. And that at that young age really resonated.
Wow.
I came from a family. My dad was a filler operator for 40 years at Coca-Cola, and my mom worked for the Chicago public school system. And so we were not having dinner conversations around investing and anything business related for the most part. And so for Brian Cressy to come and talk about his career and others to come and talk about the career path opened up my eyes to that being a viable path. And so again, to answer your question, I've always kind of had this vision of building something unique and differentiated, something that could really impact small to mid-sized businesses. When I was coming out of Harvard Business School, I had the opportunity through the Twigo Foundation to join Vista Equity Partners and jumped on it. One, because Vista had a phenomenal track record of value creation. I think one of the things that I understood up front through the interview process with them was that they only underwrite to things that are within their control. And I think that's one of the aspects I've seen so many private equity investors get wrong. They go into a company and they try to pull so many levers or change so many things at once or up front. And they don't always have an appreciation for the things that are actually in their control and those that are more macro and external to the business. And so Vista had developed a track record of success doing just that around software companies, enterprise software companies. And, I joined them as a Twigo private equity fellow. I spent my time, kind of divided my time between their investment team as well as working in-house at a portfolio company. And I would say I would underscore the second part of that, the role, the operating role, working in-house at the portfolio company, where I actually owned some of those operational improvements and was charged with implementing them. I think that was the most eye-opening aspect, and one that I think informs kind of how I engage today with owners and operators, because I have a good sense for the cadence around value creation and what's actually possible within a company. Fast forward at the end of that fellowship, I connected with a family friend at BDT and was introduced to Byron Trott and the team at BDT, and really just right out the gate had an appreciation for the business model. As a merchant bank, the firm both advises and invests in founder-run and family-owned and operated businesses. They serve as an objective advisor, providing the full suite of investment banking services, but also have a captive pool of capital to be able to support those families if and when needed. And I saw it as a very powerful combination as a merchant bank of advisory services and capital. Uniquely, I would say we had a long-term approach, and we had a long-dated fund to be able to support that approach, such that it wasn't this traditional private equity fund that typically went into an opportunity with a 3 to 5 year mindset. What we found is that didn't resonate with long-term oriented business owning families and founders. They needed long-term capital. They needed someone besides them to really help them build their business. And so it was a differentiated type of capital. And, as a result, we saw a lot of proprietary opportunities. And, in my 6 years at BDT, I wore a number of different hats, everything from helping to source and originate middle market transactions to, in my latter days there, helping to develop the firm's approach to ESG. And so, I loved everything that we did at BDT. I loved the team there and the client base as well. I think the biggest frustration gets back to the interest that I've always had in working with smaller businesses. And so just given the size of the funds at BDT, the scale that the firm operates with, we couldn't really touch anything below $20 to $30 million of EBITDA.
Right.
And so the founder of the firm actually pulled me aside to check in at one point, and I said to him, Byron, we call ourselves the merchant bank to the closely held, but we can't be the merchant bank if we don't cover the entire market. And he looked at me and said, I get it. I understand those smaller businesses are indeed the growth engines of our economy. He said, I started off my career some 40 years ago at Goldman Sachs, working with a lot of smaller businesses in St. Louis and the Midwest. And so I understand the opportunity. And he said, you've done smaller transactions across your career, before coming here. You've done everything I've ever asked of you. You've done it well. Why don't you go and start something? Why don't you go and build a firm, put together a business plan? Right. And let's talk about it more. And so that really got the wheels in motion starting in 2019, frankly, a bit unexpected. And, not with a lot of certainty around exactly when that firm would actually come to fruition. And as we came into 2020, I started talking to more people internally about it and had the firm's support to do it. And then the world kind of, fell apart and came to a pause. And so, with no hesitation, I hit the gas and continued to move forward, recognizing that, indeed there is a meaningful opportunity, I'd say, especially in the lower middle market and kind of the core middle market, companies below $20 million of EBITDA, to serve as an objective advisor and provide a long-term, flexible capital that meets those business owners' needs.
Byron is usually, he's known to have pretty good ideas. Is he one of your mentors? Could you just touch on if you have a couple of mentors and the effect they've had on you? You mentioned your professor at, I'm assuming, LFA, based on what you said.
That's correct. Yeah. I think mentorship is critical for anyone in any career path. I think you have to have good mentors around you, people you look up to, people who somewhat serve as a template around what is possible, people who've had success themselves, but most importantly, people who are willing to lean into that relationship and give back and make sure that they are supporting you and your development. And I like to often take it a step further than mentors, but sponsors. I think there's a critical difference between the two. Within an organization, I think a sponsor is somebody who will, take a bullet for you. If you screw up analysis, you screw up work, they're going to look to the boss and they're going to say, that was my fault. I should have trained that person better. And I think I've been fortunate to have a number of sponsors across my career. One of those was the gentleman who I mentioned, invited me to join him at the U.S. Treasury Department. We had funny enough, we had a incident where I did make a mistake in a client presentation while we were both investment bankers. And he said, you know what, that's not on you, that's me. And one, I should have checked the work, but two, you should understand how this works. And it's on me that you don't understand how this model works. Yep. Byron Trott and I do remain close. He's given me great advice on how to get started and a lot of strategic advice. I mean, there are some similarities between the organization he's built and what we're building here. Some similarities and a lot of differences as well. But I have a ton of respect for Byron and what he's built. And, I'm appreciative to have, his time and mind share to help build this business. Brian Cressy, who I mentioned early on, met him very early in my career, met him when I was in high school. We remained close, and he similarly has, helped me determine certain different career decisions. He was one of the first people I went to when I was deciding to actually leave BDT and build this firm, and, wanting his, not just seal of approval, but wanting his advice on the best way to do it and the best way to go to market. Chris McGowan, who is an adjunct professor at the University of Chicago Booth School of Business. He was a career investor at Madison Dearborn Partners, a middle market firm in Chicago. And Chris McGowan retired from there, started teaching at Booth. And, we were introduced close to 10 years ago. He's been an excellent sounding board, for me over the years, and has created a number of opportunities. One of which was inviting me into the Booth ecosystem to serve as a judge on his final exams for his private equity class, and more recently serving as a visiting investor and now an investor in residence at the Polsky Center at Booth.
Holy cow.
That's great. Again, really just underscoring the importance of having people who are around you, who believe in you, who want to see you be successful. I think that's really what can make or break a career, anyone's career.
Yeah, I totally agree. And I'm looking forward to, I'm assuming within 10 to 15 years, you're going to write a book, because these are not the typical mentors. And it's a great story to this point. And I think the book will come out as Jackson Capital flourishes over the next 5 to 10 years.
Yeah. Funny side note, early on in this entrepreneurial journey, so kind of mid 2019, I started taking a lot of notes. And I said, one day, these notes are going to be beneficial to someone. I think that as you go through any entrepreneurial journey, whether it's building a private equity firm, an investment firm, or any startup, launching any business, it takes a lot. It takes a lot of resources, especially if you're bootstrapping it. I think you have to expect that everything is going to take longer than you expect, and everything is going to cost more than you expect. And so, again, it doesn't matter if it's a tech startup or a private equity firm, the process is all the same, and the uncertainty is all the same. And so I've been taking a lot of notes, frankly, for my mentees. I have a number of mentees, people who I, spend a lot of time with and coach and advise, and I want them to benefit from some of the bumps and bruises that I've experienced going along the way, and hopefully make that path smoother for them when they decide to one day, launch a firm.
No, very, very good. So I'm still sweating because you mentioned your high school, and all of a sudden I went back to an important free throw I missed many years ago at LF. As soon as you started talking about the school, so I've been sweating the whole time since you mentioned LFA, because I still can't believe I missed the free throw. But anyways, Duane, if you could touch on, because we only have a few more minutes, a little bit about, I know you have some young kids, and if you could touch on your family just briefly, and then a little bit more on Jackson Capital, kind of, what you're looking to accomplish.
Absolutely. I'll share one anecdote. You mentioned, sweating because you missed that free throw in basketball. You just jogged my memory of my days in high school playing basketball. And there's one experience that, if I think back to high school basketball, this is one that just comes to mind first and center every single time. We were down about 30 points in a game. We were losing terribly, and there was no hope of coming back. Fourth quarter, about 3 minutes left in the game. Gentlemen, I won't even name the school that we were playing, but a gentleman on the other team, for the most part, we were not playing above the rim. We were not dunking, but this guy decided to jump over me and dunk, which is a bit of an exclamation point on our home court. And that is the culmination of my basketball career. So,
you were posterized.
I sure was. And my friends have not let me live it down. So,
right. That's great.
But to answer your question around family, basketball is frankly one of those things that I love to do with my son. Basketball and a number of sports. I grew up starting in high school playing golf. And so I've gotten both of my kids into golf. Started off my son when he was about 7 and took him to a golf course. He shot a 129 at 7, which is pretty good. I think his second round, he shot a 150. So not moving in the right direction, but has a passion for the game just as much as I do. I do think that family time is critical, and it absolutely gets back to my earlier comment around starting a business and what's required. What's required in starting a business is time, and there's never enough time in the day, just as there isn't enough time in a day to really, spend with family and cherish your family. I look at my 2 kids. They've got 2 young kids, a 9-year-old son and a 5-year-old daughter, and they are just growing up rapidly. There are times when I feel like I'm missing certain, experiences, but I think there's also a bit of a silver lining, over the past year, having been home, having worked from home, and for a long period of that, long stretch of that, having had the kids home, homeschooling them, I've been able to see them so much more. I've been home for dinner. I've been able to engage with them a lot more. My son is a tinkerer, and so he loves just building things. I mean, he's always building something. We're talking about building a go-kart right now from scratch. Wow. He wants to start a business himself. He's looking at me starting a business, and this is from a dad's perspective, this is a pretty phenomenal experience. But to have a kid who's old enough to understand what I'm building in my firm, to be there along the way, to be there along the journey, to understand, okay, you're having a fundraising call today. How did that go? What did you talk about? Or how's this aspect of the business going? But he's actually working on building a business himself, which is a contract manufacturing 3D printing business. It's kind of his ploy. He really just wants a 3D printer. And
right.
It costs $400 or $500. I said, no, I'm not buying you a 3D printer. But I said, look, I have an offer for you. I'll finance it, but I'm your investor, and you've got to pay this back. So you need to put together a business plan to determine the payback period for that printer and how you're actually going to make money with this business. And so, of course, that was all the motivation he needed.
Oh, that's classic. That's great.
So, it's just key to have fun with kids and with family, and to cherish those experiences growing up. You asked about Jackson Private Capital and what we're building here. And I would say that, we recognize there is indeed a need in the marketplace with companies below $20 million of EBITDA for an objective advisor and a transparent, flexible source of long-term capital. And, I think when we think about those companies kind of in that segment, below $20 million of EBITDA, there are thousands upon thousands of traditional private equity firms that are constantly calling upon them. As a matter of fact, when we reach out to a company, we have to take every step that we can to try and differentiate ourselves and our approach from that of private equity.
Right.
Private equity firms oftentimes, and this is very much being general, but oftentimes they are control oriented in some way. And with a 10-year fund life, they are often looking to complete, a 3 to 5 year transaction. In a lot of cases, if it turns into a 7-year hold, 7-year investment, it's more often because it didn't work out. They didn't hit the 30, 35% IRR in 3 years or 5 years that they wanted, and so they ended up holding that asset for longer. I would say we've, very similar to my former employer, we've really taken that approach of investing capital and better aligned it with the needs of families. We have a long dated fund, and I think you're going to see a lot more long dated funds being raised over time. But our long dated fund allows us to invest for 8 to 12 years or longer, even if necessary. We're flexible in our approach. And what I mean by that is that we first and foremost listen to the needs of those business owners and those entrepreneurs before we even conceive of any type of transaction, how we're going to structure it, the valuation, whether it's, a majority investment or a minority investment. We first and foremost listen to and understand the financial and strategic needs of those owners and operators. And only then do we put pen to paper around various different options that will hopefully help to solve for their needs. I mentioned that we can do both majority transactions as well as structured minority investments. I like to use the word majority because I genuinely believe that these founders and families who have demonstrated that they can run their businesses and do it well should continue to run their businesses as they see fit. We come in with our team. We provide a range of different resources. We augment talent. We really help those business owners realize their full potential, but they still maintain the keys to their business. And we do so over the long term, allowing them to invest in their business, frankly, in projects, capital expenditures, things that are going to have inherently a longer term payback, and it will benefit them and their continued ownership and stewardship of that business for the next generation, in a way that maybe a traditional private equity firm might say, well, we're not going to see the ROI of that investment in our investment period, so we're going to deprioritize it.
No, have you already seen the benefits of, I kind of call stuff like that a little bit opposite day. You're being, intentionally different than all the competition. And that's great. You have an open slate. So if you're going to buy Mike Kessner's business, you don't have, like you said, no preconceived notions. You might end up owning the majority, minority. You might, whatever it is. Do you have traction already with that thesis? We do. What I would say first, though, is that, I indeed still think there is a meaningful role that traditional private equity firms play, given, the track records that many of the successful firms have, the resources, the networks that they bring to bear. But I'd say in particular in the context of a family or a founder that's simply looking to maximize value upon exit. So that's the primary objective. I would say go and hire a banker, run a full marketing process, and partner with, a private equity firm that's willing to pay top dollar. It doesn't mean that we won't necessarily pay a full and fair valuation at Jackson Private Capital, but I would say our approach is more predicated on finding the right partnerships. We have a couple of advisory clients that we're currently working with. I think a few of them will need capital as we pencil out different strategic opportunities. And so in one case, we're working with a client to put together a pipeline of potential acquisitions. This is a company that is 20 years old, 3 co-founders. They've never done an acquisition. And so they looked at us and they said, we like what you do. We appreciate the fact that you have a black belt in M&A. We appreciate the fact that you have your own captive base of capital. Now, our approach as an advisor is to be objective. And so as their advisor, as we're contemplating acquisitions and advising them on the best steps around financing, it may or may not involve our capital. They may decide to debt finance an acquisition with lower cost capital, lower cost debt. And we remain objective in really showing them all of their options, but we do indeed have a captive pool of capital that we can invest in, if indeed that capital is aligned with their needs. My team and I, have been going out and frankly getting the name out there and developing relationships with a number of business owners around investment. And, I think in one case recently, the founder said to us, it was through an actual auction process. The founder said to us, you were the only firm that from day one took the time to understand what was in our best interest. And you put forth a proposal that that met the mark. He said every other firm in the process simply lobbed in a bid. And so, we are, fairly selective in who we choose to partner with. And I think that we, as investors, we will remain disciplined and, partner with companies where we really do see growth potential and companies that we feel will benefit from long-term kind of tailwinds, but highly entrepreneurial founders and family owners, that are looking to really grow that business, either near term or for the next generation. And I assume, things might get easier when you can hop on an airplane and go visit some potential clients as well.
Indeed they will. And I'm actually sitting here right now debating whether I drive down to Florida next week or whether I hop on a flight. I think the flight is optimal. So my wife, I don't know if she was joking or not. She said, if you hop on a flight, you're going to be sleeping on a sofa for the next 2 weeks.
Yeah.
I don't know if I'm willing to test that or not.
Right. Yeah. Strange times indeed. And I see we've kind of hit our time slot. On behalf of Virtus, Duane, can't thank you enough for joining the Leadership Podcast. Can't thank you enough for being a friend of Virtus. Can't thank you enough for being on our advisory board, and just super positive, and really looking forward to hearing nothing but great stories and successes from Jackson Capital.
I appreciate it, Mike. I absolutely appreciate the opportunity to catch up and to really share the Jackson Private Capital story. So, thank you.
You're welcome. We'll catch up soon. Thank you, Duane. Appreciate it.
Sounds good. Be well.
You too. Bye-bye.